I hope everyone enjoyed their salmon luncheon. We're going to start off this afternoon with former Taoiseach John Bruton. John and I have known each other for a long time. I first met John. He was kind enough. He was when he was during his Taoiseach days, and I was getting a tour of the Dáil with Jimmy Deanahan. Jimmy is former TD, I'm sure most of you know from Curry, and famous footballer. And so I was here with a friend of mine named Jim O'Brien, Jim is a former NFL football player in the U.S., and he and Jimmy were good friends, and Jimmy decided to give us a tour of the Dáil, and so we're walking down the hallway, and who pops into the hallway with us was John Bruton. And John said, "Oh, come on in my office," and gave us some of his time. And I thought to myself, I can't imagine that happening in the White House or in the Congress or whatever. So anyway, John was kind enough to visit Philadelphia on a couple of occasions and speak to the Irish American Business Chamber and some of the other groups there, including some universities. So without further ado, we've asked John to speak today about politics and the economy in Europe. So please welcome John Bruton.
I'm delighted to be here, and I'm delighted that Bill invited me. As I'm on the board of Smart Invest, which is one of your Diamond sponsors, which is another reason why I'm here, and I want to compliment them on the work that they're doing in building up an investment fund that hopefully will help create jobs not only in this country but in Philadelphia and indeed also in the Middle East. What I would like to talk about really are the challenges facing Europe, and this flows quite well from John's address before lunch. First thing to say is when you hear the word Europe mentioned, or the word European Union, or the word Euro, the first thing that springs to mind is problems. Well, yes, there are problems, and they are generally the sort of thing that newspapers write about. They don't report that the trains ran on time today. If there's a train crash, they report that. And I think to some extent we tend to lose sight of the positives of both the European Union and of the Euro as well. In the case of the European Union, what it does is provide for the states that are in it, 28 of us at the moment, soon to be 27, but I'm sure we'll find a replacement for the 28th that's leaving. There's quite a significant line of people wanting to take their place. And incidentally, there are no states wanting to join the United States of America just yet, whereas we have quite a queue of states wanting to join our little union here in this part of the world. But the positives of the European Union are, first of all, that it is big enough to take on global corporations. We in Ireland have reason perhaps not to be happy with all of their initiatives in this area. Their recent sally in regard to clipping the wings of Apple in regard to tax policy in the way in which they are able to avoid paying tax will not commend itself to everybody in this country. But it does show that the European Union is big enough to take on some of the major economic forces in the world today, in a way that any one of the 27 states, even Germany, because all of us are so dependent on trade, could do. Secondly, they can champion the interests of the consumer in ensuring that there are safety standards, and both in respect of the provision of services and in the respect of the provision of goods. And they have the clout to deal with monopolies, which might exploit consumers. Again, given the interdependence of the world, no one of the states in the European Union is big enough to do any of those three things. The European Union is big enough to do them. And if the European Union didn't exist, we'd probably have to invent it precisely to do those things. The other thing that's important to say about the European Union is that it is the only multinational organization that has a serious policy agenda that it is implementing, which is actually run democratically. There's no elected parliament of the United Nations. There's no an elected parliament that's a co-decision maker in the World Trade Organization or in the Bank for International Settlements. They're multinational organizations, very important multinational organizations, vital multinational organizations, but they're not democracies. The European Union is a multinational organization which is a democracy, in the sense that every decision that the EU takes has to be approved. Every regulation that people complain about has to be approved by a democratically elected European Parliament and by democratically elected ministers sitting in the Council of Ministers. Now, you didn't hear that said very often during the British referendum recently, but it's still true. So that's a positive, I think. As far as the euro is concerned, I know it tends to attract more criticism perhaps than the union itself. But it's important to say that what the euro does, apart from the convenience of not having to pay, exchange from one currency to another, and with electronic money, that's less of a problem anyway. We could possibly cope with that without the euro. But what the euro does is provide a system of mutual insurance. Probably we were a bit late setting this up, but we're setting it up now in response to the crisis of 2008. Mutual insurance for governments that might go under through their own fault or not through their own fault, and mutual insurance gradually for the banks of the European Union when we have implemented deposit insurance. And by giving mutual insurance that's based on the assets of all 27 or 28 members, we create an opportunity for smaller countries to trade on a bigger market. If you didn't have the European Union, it would only be the banks from the bigger countries that would have any hope of working. So I think we need, before we sort of go through all the things that are wrong about the euro and wrong about economic performance in Europe, we need to keep an eye on the essentials. And I've mentioned some of those. Yes, it's true, as John said, that economic growth is slow in Europe. 1.5%, I think you mentioned, as the prospect of growth. The problem that we have is that there's no consensus, I think, among the electorates of Europe. And the electorates are important. It's important. Central bankers are important too. But if electorates don't have a consensus about what makes an economy grow or what's stopping an economy from growing, if there isn't a consensus among electors on that, then it's very difficult for central banks or governments to do very much. And there isn't a consensus among the electorates of Europe about what is the economic problem in Europe. Some who will say, oh, it's all about austerity. And they just leave it at that. As if austerity was something that any government would freely choose to impose on its own people. No government that imposes austerity does that out of any malevolence. That occurs because they perceive it as being necessary. Now, whether they're right or not is something that can be debated. But criticism of austerity passes for a policy in many quarters in the politics of Europe today, and people don't feel they need to go any further in analysing why the austerity is occurring or how it could be avoided. And what's, I think, particularly missing from the debate are two things. One, a true understanding of what are the, if you like, blockages in the arteries of the European economy. And I see the EU's programme of promoting structural reform, whether it be promoting competition in the milk market in Greece, or promoting an opening up of the legal profession in Ireland, or making our courts more efficient, or any of the myriad of small reforms in all 27 countries that the European Union is trying to encourage member states to undertake. What that is simply removing cholesterol from the veins of the European economy. It's simply allowing the blood to flow by ensuring that the people who, if you like, by imposing a little blockage somewhere in the circulatory system are able to make excessive profits that they're taking on, and their monopoly or their duopoly or their oligopoly or whatever is mitigated or dissolved. So this is what you do with cholesterol, you dissolve it. Well, the structural reform of the European Union is designed to dissolve things that are potentially blocking the arteries of the European economy. Now, when it's explained like that, it actually makes sense. The problem is it is so rarely ever explained like that. Because the people who are explaining it in the European Commission are used to talking economics speak, used to talking to other economists, have their reputation made or not by the opinions of other economists, but not by members of the general public, with whom they really do need to communicate. Clearly, the other big thing that's ignored, and it's John talked about rather politely about the need for fiscal policy action by governments to, shall we say, make up for the fact that, I think, whether you said the central bank had shot their bolt or it was something like that, that they'd exhausted all the ammo in their stockpile or whatever, and that it was somebody else's need to come in there and do something to shake the economy. There's a big limitation on that, in my opinion, and I think this is a limitation as well that has to be taken into account when we have this discussion about should government in Europe be investing more in roads. And I think they should if they can. And I think they're not doing enough, and if you look at the figures for investment, they're well below trend in recent times because investment has taken the hit for the fiscal consolidation that's been necessary. But the big inhibiting factor that doesn't seem to be mentioned in this subject, and I recently read Joe Stiglitz's book about the euro, where he was saying how the euro was going to drag down the European Union. And I must say I expected to be even more annoyed reading the book than I was in the end. But I still, in all 360 pages of this book where he was talking about how the euro was to blame for everything and how if it wasn't for the Germans, saving too much and not spending enough, that we'd have no problems. The one thing he never mentioned was the aging of European society. Europe is not as young as it was in the 1990s. There have been estimates done by the European Commission which suggests that where we have, I think, a debt to GDP ratio on average in the European Union, I think it varies between the Eurozone and the Union as a whole, but not significantly, around 90%. That, unless we change our policies in respect of health and aging, health and pensions, that if we continue with the present level of commitment to pensions and the present level of taxpayer commitment to paying for the increasingly frequent visits to the doctor of people in my age group, the debt to GDP ratio, without any change in policy, will reach 400% by 2060. Now, 2060 will eventually arrive, not for me, but for some of you here, it will arrive. And we have an obligation not to run up more debts. If we're already sort of at the critical level, near 100% of GDP, we have to be very careful to ensure that the return on the investment, the total economic return on the investment, I'm not talking about pure financial return, but the total economic return is enough to pay down that debt and to service that debt in what may be a very different interest rate environment 15 or 20 or 30 years from now. And that's what's holding governments back. But you rarely ever hear the issue of the cost of aging mentioned in the same sentence as the calls for stimulus and investment. And yet they are interrelated. Now, I've no doubt that there are investments that government can make that will be entirely justified against that background. But one needs to be selective. I read Juncker's speech last year, State of the Union, and he talked about the big investment that Europe is making, this new fund, his Juncker fund. And one of the things he mentioned was, well, they've invested in a health centre in Limerick. I was sort of figuring, where was the financial return going to come from that? Is that an investment or is that consumption? I'm not sure. Yes, you can call anything investment. So I think we need to be quite rigorous here about this. Now, I think it's accepted that if we have a single currency, we've got to have rules. We've got to have common rules about the printing and the money. Now, we thought when the euro was launched, and I was one of the people in the moving cast of characters that was involved in government in the 90s, when the rules for the euro were being worked out. And a lot of effort was put into making sure that governments didn't overspend. We have a debt to GDP ratio, 60% target, deficit of 3% of GDP, which was supposed to be an upper limit, not the minimum that you would borrow. That was what was set. But all the focus was on mistakes that might be made by the public sector, because the assumption seems to be that the only irresponsible people in the world are politicians, and that once you control them, everything was fine. But nothing was done. Nothing was done at European level to control the creation of liquidity and money by the banks. And while the creation of liquidity by government was the problem in Greece, and undoubtedly that's their fault mainly, although you wonder how hard people looked at the statistics when they could have looked them, or whether Germany enabled Eurostat to have the resources to investigate the Greek numbers in time. There are questions that need to be answered there. But next to nothing was done to supervise the growth in credit through the banking system, which was the problem in Ireland, Portugal, Spain, and so on. Why is it that we had lots of specificity in the original design in respect of controlling politicians, and not an equivalent degree of specificity in respect of controlling the issuance of our common money, the euro, by the banks across borders and within their own jurisdictions? And I think the reason is, of course, in part, that the politicians were protecting the interests of banks in some countries, notably, I think, in Germany, where their banking system probably wasn't really ready for all the scrutiny and isn't even yet getting the scrutiny that it deserves to get. So the politicians made themselves the target, when in fact they might have had a wider range of view. And there isn't a consensus even about that yet. We haven't got mutual deposit insurance. We haven't got the legislation passed on credit default swaps. And there is more work to be done. But to be fair, a lot has been done since the crisis in establishing a more subtle system for controlling governments, which takes structural deficits into account, and a more developed system for supervising banks. But I think it's going to be interesting to see whether the bank supervisor adopts a sort of narrow rule-based approach, which the Germans would like, or is it going to have a more discretionary approach, which perhaps might be the French approach? Which of those two approaches is going to work? Obviously, the more detailed the rules are, the more predictability you have, but you can't predict everything, so you need discretion. So supervisors are going to have courage to step in. And I think the big test will be when the first bank has to be closed down. That's going to be a big test, because it will be closed down in a particular country. And everybody will say, oh, we're being picked on. And this, again, is part of the difficulty that we're facing, that countries don't fully trust one another. The Baltic states, for example, feel that the full rigors of the fiscal pact were imposed on them, whereas the Spaniards and the Portuguese and the Italians have been able to maneuver around for good political reasons. Good political reasons. I'm not against political reasoning here, but there's a limit to what you'll get away with in not applying rules evenly to everybody, and I think it's important that the authorities don't test those limits too far. That's enough about the European Union, other than I want to say a word or two now about the big decision taken by our neighbour to leave the European Union. I think this is going to involve a massive disruption. Massive disruption because I don't think the UK has a clear idea of what it wants in terms of what it might realistically get. I mean, they have an idea that they'd like to have all the benefits of EU membership without having to make any financial contribution, without having to apply EU rules, without having basically that they would make the rules and that the EU would apply them rather than the other way around. That's not going to happen. I wonder, are they capable in Britain of producing a proposal to the rest of the EU when they send the Article 50 letter, that the rest of the EU will say, well, I see, they've been not just thinking about the British problem, they've been thinking about the Greek problem, they've been thinking about the problems with the negotiation that Ireland might have, the problem that France might have, the problem that Germany would have, and they've come up with a proposal that's sort of within 10 to 15% of what might be acceptable to the EU side. That they've thought their way into the problem of the EU before they make their proposal. Now, you all know that in negotiation, apart from knowing what you want, you have to know what's the minimum that might be acceptable to the other side. And I ask the question, is the UK system, given the diet of anti-European rhetoric that it's been living on for the last 20 years, is the UK system capable of thinking its way into the minds of the people who will be negotiating with on the other side of the table and come up with a proposal that will satisfy everybody? Or will that, with adjustments, might satisfy everybody, rather? Or will they try and pick off the Germans and set the Germans against the French and pick off the Irish to set the Irish against the Baltics or whatever? If they approach it that way, they're doomed. They'll not get an agreement. And it'll be a hard Brexit, and the hardest effects of the hard Brexit will be felt on this island. And I think it's going to require immense imagination on their part, thinking their mind into the concerns of continental Europe, for them to come up with a proposal for Brexit that has a reasonable chance of being accepted. I see no sign yet at all in the debate in Britain that they're coming anywhere near to that. And of course then, once they've tabled the negotiation with the started the negotiation with the EU, they have to, as a non-member of the EU, they have to negotiate 50 different trade agreements with all the countries that they now have agreements with as a member of the EU that they won't have an agreement with once they leave. They're going to have to draw up a schedule for rejoining the WTO as a full member on their own account. The negotiations on trade that the UK has set itself, will take 30 or 40 years potentially, because there's so much stuff that has to be done if you take the speed of normal trade negotiations. But we're going to have to live with that. Obviously, there are some minor advantages for Ireland in this. I think we shouldn't exaggerate them. The losses are going to be right across our entire economy. Huge losses for agriculture, huge political losses in terms of stability in Northern Ireland, huge losses if we have to impose a common external tariff, we'll have to introduce a whole the customs service will have to be beefed up. The whole frontier control system will have to be put in place if there's a hard Brexit, which looks like where we're heading. That's all cost for this economy. Plus, we're going to be isolated in the EU as the only English-speaking offshore island. We're going to be a bit like Greece was when Greece was the only EU member anywhere east of Italy and was physically cut off from the rest of Europe. We're going to be physically cut off from the rest of the Union by Britain, by the Britain existence as a big non-member beside us. It's going to be very disruptive. So the only hope is, I think, that we get a lot of financial services entities to shift from London to here. Now, they're already publicly saying that they're moving. Bond trading platforms, equities trading platforms, the infrastructure. If you can attract the infrastructure from London Dublin, then others will follow. We have already very sophisticated aircraft leasing, funds management, asset management, international banking, treasury operations here in Dublin. We have the skill base, we have the common law, we have the predictable tax system, at least we had, and we need to exploit those. But central to this endeavour of attracting business from London is not going to be the IDA. We're traditionally of the view that foreign investment comes in here through the Industrial Development Authority or Irish Development Agency or whatever they call themselves now. It was IDA or the initials anyway. The central bank is going to be central to this because they are the regulator. And what these people are going to know, and we have an independent central bank, but independence doesn't mean that you don't listen to what other people from whom you're independent might say. Because independence it's important, but it exists in a particular country, which is Ireland. I think it would be good if the central bank were to consider publishing a white paper setting out what would be the regulatory environment that they would have or would aim to have for the different types of financial service operation that are currently in London that could be induced here. Now obviously this white paper wouldn't get into all the nitty-gritty of the details, but would at least show to anyone who in London who's having to make a decision between Luxembourg or Paris, where they're promising to do everything in English, I see, or Lisbon, which is very close to Britain historically, as we all know, or Cork or Dublin or whatever. We need to at least put out our stall there and show what might be the regulatory environment. Now, that's something that the government can't tell the central bank to do, because the central bank is independent, and rightly so, essentially so, in light of some things that have went wrong here in the past. But that's not to say that the central bank might not consider doing this as something that would be good for the country, of which they are the central bank. Now, I was asked to talk about Europe's challenges, and I've talked about the economic challenges, I've talked about Brexit. I'd say just a little bit, and I won't take as long on this, about the other challenges. There's a huge worry about immigration, as we know, and it's mixed with a worry about Islamic terrorism and the failure of many communities in Europe to integrate people of a different faith or ethnic background into the mainstream community. Integration is more difficult, I think, in an urbanized setting because it's possible to be anonymous and to drop out of the mainstream of life if you live in a big city, or to form a ghetto in a big city, whereas if you're immigrating into a traditional rural society, well, you really have to work with your neighbours. And I don't think we've found in Europe an adequate way of integrating new communities coming in. We're doing pretty well at it in this country by comparison with others. They've done well at it, I think, in Britain, where better I would have thought than they've done in France or Belgium or Germany. And I think those countries need to think about an integration policy. I think we also must make sure that we are not terrorized by terrorists. Remember, all these acts of terror are nothing more than the propaganda of the deed. They are using the killing of people in order to terrify a much, much larger number of people. To the extent that we report these events and obsess about these events, we're actually doing the job of the terrorists, because we're creating the magnification of the problem that is their goal. They want, for the minimum of risk on their part, to create the maximum terror among the maximum number of people. So I think we need to be careful about how we react to this, that we don't legitimate them. We don't give them, treat them with the sort of respect they do not deserve to have. Because these are criminals. These are criminals. That's all they are, criminals. Many of them have actually been recruited in the prisons. And we should not dignify them. And I think that psychological approach to terror is the best antidote to it. And I think that in this country, we have learned lessons along those lines. There are, of course, other problems that have to be coped with. I think there is a big potential concern about the situation in Bosnia, where, as you know, First World War started in Sarajevo, and it was an expression of the difference there between the Serbs, the Croats, and the Bosniak communities. That's not settled now. And the best efforts and expenditure of money from the European Union hasn't solved it. And of course, others, as was the case back in 1914, like to meddle in that particular part of the world. The Turks, the Russians, they've always had an interest in the Balkans, but now the Saudis are getting interested. And I think we need to be very conscious that the United States is not going to come in again to save Europe's bacon, as they did in the Clinton administration. This will be our problem in Europe. We're going to have to solve this problem in Europe at our back door. And I think it's something that we need to be thinking about, and I think we in Ireland need to be thinking about it, because our island status doesn't inure us to the problems of the wider world. With cyber warfare and mass movements of population, being an island doesn't insure you against problems that you should play a part in solving. And I think that's going to be important for us. And I think there's also the risk that the United States may look elsewhere and may not take the interest that we would assume it would take in Europe's problems. Nobody really has criticized Donald Trump for saying that America's allies should pay more of the cost of their own defense. He's been criticized for lots of things, but I don't hear him being criticized much for that. And he's playing into an isolationist trend of opinion in the United States, which has been there forever, talking about a 45% tariff on imports from China at the time when he might need the cooperation of China to deal with the North Korean nuclear threat. I wonder how clever that is. I wonder how clever it is to be talking about pulling back from the Korean agreement at the very time that, again, South Korea needs to be helped to deal with the problem in North Korea. I wonder how smart it is to be talking about a 35% tariff on goods imported from Mexico. Mexico, which is a neighbor of the United States, which shares American values in a very great degree, and which is potentially a great friend of the United States. It shouldn't be blamed for problems that there may be in the internal distribution of income within the United States for reasons that are entirely to do with the United States itself. And I have to say, I don't think it's inspiring to see former Secretary of State Clinton talking about walking away from the Trans-Pacific Agreement at a time when America's allies in the Far East are feeling very vulnerable as a result of the Chinese claims in the South China Sea, claiming against any understood norms of international law that waters that are much nearer to the Philippines and other countries like that really belong to China for some reason, going back to the Ming dynasty or something like that. I think to be contemplating, for the Democrats to be contemplating not ratifying the TPA in those circumstances, shall we say, isn't great. And I think also we here in the European Union, I'll stop on this, we need to be able to ratify the Canadian trade agreement. Because if we fail to do that, we're then saying that Europe can't do business on behalf of its 27 members internationally. Because we can agree things, but we can't ratify them. And I set out at the beginning of my remarks what I thought were the positives of the European Union, that it provided this economy of scale for small states and an ability to do business on behalf of all the members on the global scale. But if we can do business with the Canadians, but then can't ratify it, then there's a problem. And it certainly signals we won't find it all that easy finalizing the TTIP with the United States. So there are lots of political challenges, but we're better equipped to deal with those challenges because we have a European Union than we would have been to deal with similar challenges 50 or 100 years ago. So, unlike the voters of the United Kingdom, let's hold on to what we have and make it work better rather than reject it.
There you go.
Yeah, good afternoon. Michael McVean, our chairman, has asked me to do double duty, so I am going to moderate and speak for our next panel, which is Navigating in a Global Economy. I'd like to ask Megan Green and Carl Whalen to come up. Hopefully we have them both here. We're running a little bit behind, but I think we'll actually catch up by the time of the coffee break, more or less. You got your slides? You have slides? I don't have slides, by the way.
You have no slides either? No.
Okay. No, understood. You're going first, then. All right. First, let her go first. Oh, agree? Oh, yeah, okay. So, no, but why don't you go ahead? Why don't you go right ahead? 15 or so, and I'll give you a warning when you get there.
I won't need 15.
There you go. Love it.
Okay. Great, thanks. So in terms of navigating the global economy, I thought I would go ahead and set out my vision for the global economy. I'm used to going around and doing global macro overviews. That's pretty much my job. I'm the chief economist at Manulife Asset Management, incidentally. But I usually speak for an hour, and I'm not going to do that to you guys. So instead of going through major economies, I'm just going to talk about two major themes that I kind of arrange all my thinking around. And the two themes are oversupply and uncertainty. And the theme of oversupply is going to drive macro trends and markets, I think, for the next 5 to 10 years to come. Uncertainty has become a really big issue more recently, particularly in the past year. But I think we'll be here to stay as well. So in terms of oversupply, we have an oversupply of a ton of things. But first of all, we have an oversupply of debt. So even though every single major economy has tried really hard to deleverage at every single level of the economy, so households, financial sector, corporates, governments, overall debt has actually just gone up in every major economy. And so usually if you live in this world of oversupply, the first port of call is for government to step in and provide a fiscal stimulus. But because of this massive debt overhang, we haven't seen that happen. That might change a little bit, actually. But what we really need is a globally coordinated fiscal stimulus. We're not going to get that, least of all because the Europeans are going to put the kibosh on that, I think. So in the absence of a massive fiscal stimulus, central bankers have been the pinch hitters, to use a baseball term. And so they've had to step in as the only game in town. And so that's had a bunch of distortions on financial markets in particular. First of all, central banks have pushed a ton of liquidity into the macro system, not into the markets. There's actually been a dearth of liquidity in the markets, but in the macro system. And one of the results is that government borrowing costs have compressed massively. So I've put charts together for a number of Western European countries going back to the 1700s, and yields are at multi-century, multi-generational lows. Another implication is in terms of currencies. So the U.S. Fed was the first central bank to go ahead and do this. And as a result, now that the Fed is actually normalizing monetary policy, or trying very hard at least, while everybody else is easing, for years to come. The US dollar is strengthening against most major currencies generally. In addition to pushing tons of liquidity into the macro system, we've had negative rates. Negative rates weren't that controversial when they were first announced, but I think they're an absolutely terrible idea and are incredibly dangerous. We've never used them before, so they're complete experiments. But one of the implications is that we now have a third of outstanding European debt negatively yielding. So for my portfolio managers, they have to plug the yield into an equation, and it kicks out a valuation for equities in particular. And if you have a negative yield, then the valuation for equities literally goes into infinity. So you can only imagine the distortions that's creating in financial markets. Now we finally have yield curve management in Japan, which I think is just a precursor to helicopter money, and eventually I think we will have helicopter money as well. I should say I think that central banks stepping in to do all of this has also marked the death of the business cycle. So typically we have a recession every 10 years roughly, but the kind of repricing that you naturally have in a business cycle would be so painful these days that central banks globally keep stepping in to avoid that repricing. And as a result, we have this really sluggish, long recovery, incredibly long business cycles. I wish I could say that the death of the business cycle means we can't go into recession. Unfortunately, that's not true. We could still go into recession. But I think our business cycles are incredibly long, if they even exist at all. And I did most of my graduate and undergraduate research on populism, and the economics of populism. And at the time, I thought, when is this ever going to be relevant again? But it turns out it's relevant now. And populists tend to do really well when the economy's not particularly robust. And so given the death of the business cycle, I think it's given populists a really long runway to consolidate support, and we're seeing that across Europe and the US. Finally, we have an oversupply of a couple more things. One is years, I guess, age. So our demographics, aging population. Ireland might be the only Western economy that isn't facing an aging population. But in any case, that is obviously, an aging population is obviously having huge implications for productivity growth. We have an oversupply of regulation, so most banks complain to me that they can't do their job anymore because of all of this regulation. And regulation goes in waves as well. You could say there are regulation cycles. Unfortunately, I don't think we're at the end of this one, so I think we can expect regulation to get worse before it gets better. And finally, we have an oversupply of really cheap labor globally. So as China industrialized and urbanized, as the Iron Curtain fell and we added all of these workers to the global workforce from Central and Eastern Europe, as India is industrializing and urbanizing, we're adding billions of workers to the labor force. We've never had that before, and as a result, we have really cheap labor globally, and it's not like companies are just hiring domestically anymore. So if you have an oversupply of really cheap labor, you don't have a whole lot of upward pressure on wages. And if you don't have a whole lot of upward pressure on wages, you don't get a whole lot of upward pressure on inflation. And so we're seeing every major central bank miss its inflation targets. I think the exceptions are Russia and Turkey, not exactly models for the rest of us to follow on that front. So I think we'll miss our inflation targets for the next 5 years to come in every major economy as well. So in terms of, that's it for oversupply, but these are huge global drivers that I think will continue to drive the economy and markets for years to come. Uncertainty has become a really big issue, particularly in the past year. And usually people think that economic indicators are the cause of uncertainty, but I think actually now it's going the other way around. I think uncertainty is having an impact on the economy. So just some proof that uncertainty is at pretty unprecedented highs. Bloomberg's U.S. Economic Policy Uncertainty Index is at levels we haven't seen in 5 years. Investor sentiment neutral readings are at levels we haven't seen since 2003. The share of analyst hold recommendations is up significantly this year from last year. And the number of companies with neutral earnings per share guidance is the highest since 2007. Just anecdotally, as an economist, often when I go to these kinds of events, we all have to write down our economic forecasts and our forecasts for rates, things like that. And I have found over the past year that we pretty much all have the same forecasts. So no one's really able or willing to take a stance on either side. There are very few out of consensus calls these days. So So I think that's an indication that uncertainty is really high as well. And there are two major implications of so much uncertainty. And actually, first I'll talk about the causes of so much uncertainty, but we've heard a lot about it already. One, there's an election coming up in the US, obviously. There are a ton of elections coming up in Europe as well. The next 12 months is an incredibly busy election schedule, and I think that in every European country except for Cyprus, there's a populist party that's doing pretty well in the polls, or at least increasing their opinion poll ratings. We still don't know what Brexit will look like, and when I was last in London 2 weeks ago, everyone was thrilled that the UK hasn't fallen off a cliff yet. Just wait for it. I think nothing has fundamentally changed as a result of Brexit. Article 50 hasn't been triggered, but anecdotally, I know a number of companies were planning on buying companies in the UK and now aren't. And we don't have any metric of how much investment now isn't happening that had been planned, but we do have investment indicators. A survey came out this morning showing that plans to invest in the UK had fallen off a cliff. So we haven't seen capital leave yet, but I don't think we're seeing any new capital flow into the UK. And that will affect the economy. Monetary policy diversions and general geopolitics, I think, is causing a lot of this uncertainty as well. So what happens as a result of this uncertainty? First is consumer behavior has been really distorted. So usually as your wealth increases, your savings decrease, or your savings rate decreases. We're actually not seeing that anymore. There's been a real divergence. So as wealth is increasing, savings is also increasing. Also, consumer confidence for current conditions keeps going up and up and up, but expectations for what things will be like in the future is just flatlined over the past year and a half. And in addition to consumer behavior being distorted by uncertainty, business decisions are all on hold. So there's a CEO confidence index for 1 year out, and it's been falling since 2014, for example. There's a ton of money on the sidelines, which I guess on the bright side means that there's some opportunity for some of that coming in with a different policy mix. But I'll leave it there, pass it over to Carl.
Well, thank you, Megan. And forgive me for not introducing you properly. You're part of the larger Manulife life insurance company, right?
So, yep, so I'm connected to the asset management
Right,
firm.
gotcha. All right, so next we're going to hear from Carl Whalen, who I don't think is a relative, but he could be, from University College in Dublin.
You're a whaler, I'm a wheeler.
We're Phalons, actually.
Whalens and wheelans. Okay, I apologize in advance. I have a bit of a cold. I don't know if somebody could get me a glass of water.
Yes, good. Grab a bottle of water.
As he grabs to the Tic Tacs. Good. Okay, I should be able to talk, if maybe not as fluently as Megan. Okay, I don't really have any idea what navigating the global economy means. I have this terrible fear that it's something to do with forecasting. And economists are terrible at forecasting. I thought instead I'd reflect a bit on, I guess, what we learned about monetary policy in the last decade, and where the world's major central banks are situated today, and the kinds of issues that are likely to face, and fiscal policy issues that will be faced as we move towards what is likely to be an inevitable global recession that will arrive at some point. An indication of why we aren't very good at the forecasting business comes from casting your mind back to about a decade ago. And at conferences like this, there prevailed what's known today as the Great Moderation Consensus. Maybe it wasn't as consensual as all that. There were various debates. But people agreed on a lot of things. They agreed that the global economy was very stable. And they agreed that very smart, well-designed fiscal and monetary policy, in particular monetary policy, was a major part of that. And that's because we had wonderful people like Alan Greenspan, who was a maestro at running monetary policy, not a man with a strange philosophy, odd views on the economy. A major element of smart monetary policy was that it was highly independent from fiscal policy, and that it had a focus on inflation targeting, and we had even become so scientific in this, we'd even figured out the right number for inflation. It was 2%. 2% was the right number. We figured that out. I managed to work my way through graduate school in macroeconomics, and I missed the paper that said the 2% was optimal. Must have been an important one though, but I must have missed that week in class. And I think a lot of there's a lot of focus on how in the last decade things have changed and new elements that were brought into monetary policy, but I still think the prevailing the great moderation central banking toolkit is still has a huge amount of influence and has prevented things that are feasible and can be done from being done, but perhaps for not much longer. So one thing the great moderation consensus clearly missed out on is that very large financial shocks can happen. So I see this as a global interdependence center event. So global interdependence has good sides and it has dangerous sides. And the dangerous side is very, very large gross financial flows sloshing around the world and nobody really understanding their implications. It is possible that the Great Recession of 08, 09, etc. Was a once-off event, and fantastic global financial regulation will prevent it from happening again. I think that's unlikely, and some large global financial event is likely to occur at some stage. And what we found was that when you have this kind of event, central bankers operating with a 2% inflation target run out of their normal ammunition very, very quickly. The general formula for what the nominal interest rate should be is your inflation target, which of course is 2%, plus some estimate of the real interest rate that stabilizes the economy. Now, one thing that's happened over the past decade is estimates of what that stabilizing real interest rate is have gradually declined. So one of the papers I teach my graduate students is Lobach and Williams' model of the U.S. economy, and it has this R star, stabilizes the stabilizing real interest rate. And John must have some RA at the San Francisco Fed that presses the button every quarter and updates the model. So you can just get the spreadsheet. R star has gone negative, according to Lobach and Williams anyway. And that may be a real thing to do with low productivity growth, to do with demographics. It may be something to do with secular stagnation. I still don't know what secular stagnation is, and I stare at Larry's speeches long and hard. But it certainly does seem that, I mean, it bears out in the sense that the level of stimulus that has been provided to lots of the world's global economies by effectively zero interest rates has not provoked the kind of growth that you would expect if equilibrium real interest rates were what they used to be. In the absence of being able to cut interest rates much below zero, there's a lot of hand-wringing about negative rates. I wouldn't worry too much about Megan's colleagues and their spreadsheet problems as a side effect of negative rates. It's easy to get hung up about it and get all emotional about a number dropping from 0.1 to minus 0.1. In practice, if you look, for instance, at Europe, you know, what you've seen is that negative rates have been part of a toolkit that have allowed rates at which the public, you know, households and businesses borrow at, to come down. Right? So that you won't get a negative interest rate loan from Bank of Ireland here or AIB, and so it's just a part of the toolkit. It's been interesting to see how low they can go, and again shows the sort of limited economist understanding of this. So I used to teach about the zero bound. And I said, oh, you know, if interest rates go negative, you can just take out cash, right? But of course, if you're a major financial corporation, it's difficult to walk around with billions and billions of euros of cash in your pocket. You can put it in a warehouse somewhere, but okay, but how do you, if you actually want to buy 50 billion in treasury bonds with the money in the warehouse, who counts it? But it's the actual costs of trying to get around the zero bound via the use of cash are, I think, much more substantial than we had realized, and we can probably push that a bit further. But ultimately, negative rates, to the extent that we can push them, and QE, which has had an impact, and it's had an impact via effects on asset prices. Again, there's a lot of whining globally about distortions and this, that, and the other. I mean, QE was supposed to raise asset prices. That's the mechanism through which this kind of thing is supposed to work. Given the kind of global monetary policy stance, given where interest rates are, how distorted are asset prices? Well, if you think that the low rates themselves are distortions, then so be it. But it's not always that clear that that given monetary policy that this thing is distorted. The word distorted gets thrown around in a way that I think is a bit strange. But QE has had an impact. But if you go and look at the research from the Federal Reserve, Bank of England, various places that have looked at this, it's relatively small. Right? For the very, very large amounts of money printed off, the enormous political issues that are raised by holding such large amounts of treasury debt or gilts or whatever, it's probably had an impact something like 75 basis points, 100 basis points on interest rates. Ultimately, which raises the bigger question, why don't we operate with a higher inflation target and have a lot more ammunition? I was interested to see the CPR Geneva report that Patrick Onahan was a co-author on, has a quite extensive discussion of that more recently. But it appears the hang-up over independence, the hang-up over 2% as a magic number is such that that's not really ever going anywhere. People say things like, well, if you can't meet 2%, how credible is it going to be to say you're going to meet 4%? It's not clear the Bank of Japan's experience in raising its inflation target has been particularly successful. But then on the other hand, I think there are things that you can do over and above just announcing a higher target. In many countries, the governments themselves can contribute to inflation expectations via the fact that they pay a lot of people, whether it's via transfer programs or whether it's via wage programs. If you start announcing, well, I give everybody 4% plus GDP wage increase because this is the new norm, this is what we expect, that'll do its bit for inflationary psychology, which often isn't necessarily that complicated. But of course, that requires a fiscal and monetary policy coordination, which is supposed to be a bad thing. So where we are right now, in areas such as the countries such as the UK and the US, I mean, if you'd said to somebody 10 years ago, the UK and US are going to have unemployment rates of below 5%, and that interest rates would be zero, people would have said you're a crazy person. It's not possible. And it probably isn't necessarily the best place to be. My sense of one of the other things I update every year is Glenn Rudebush's calculations that he did a number of years ago on how negative would interest rates have been. And the answer is very, if you'd followed a sort of a Taylor rule. But it's also the case that interest rates, according to an old-style Taylor rule, would have been very positive over the past couple of years and getting higher. So in a sense, I think the mode that you see the Fed and the Bank of England in at the moment is this sort of extreme inflation targeter. Right? It's, okay, unemployment's really low, the economy's doing well, but look, we're still below our inflation target. And it's sort of a mono-focus on the inflation target. And that's one way you can operate. But when recession comes and you find you very little ammunition left, that may prove to be a mistake. It may well be that the kind of growth that we're getting in this last couple of years, as it's almost certainly going to be, of an expansion, perhaps comes at the expense of what happens later. If you look at the Fed forecast, what's going to happen to the economy? Unemployment rates, going to be 4.5% forever. It won't be. Never is. Every time in recent decades that unemployment has reached something like this level, something nasty has happened, and actually very quickly, usually. So I think that's one sense in which they're out of ammunition. Or, you know, they should probably have more ammunition now than they're going to have. What will happen when you hit the next recession and with a limited room for interest rate cuts? You may see more debate. It may take two nasty global recessions to fully unshackle us from the great moderation ideas. Central banks may become less independent. They may think about things like helicopter drops. All that stuff may happen. Probably not. Probably takes even longer to change central bank thinking. And perhaps for good reasons, right? Of course, once you've done the helicopter drop policy, which would be enormously popular, right? It's going to be hard to tell the public, no, we only did it that one time, right? No helicopter drop this year, guys, right? Which leaves fiscal policy. And of course, you hear all these claims that there's terrible fiscal policies around the world. Megan points out there's lots of debt. The world is swimming in debt. Well, you know, who do we owe it to? Mars, right? So there are various, you know, distributional issues. John Bruton talked before about that it's difficult for Europe to undertake activist fiscal policy because we have all these old people. These people are going to get old. They're going to have to go to the doctors. It's true. It's true. But I mean, I think what this really is setting up is a sort of intergenerational battle. Financial markets have learned the lesson that when with a central bank that can print lots of money and purchase lots of bonds, that there's no default risk. They will lend money to governments in the next recession to do capital spending projects. Governments will accumulate more debt. Maybe at some point, one of the shibboleths that will go in terms of the great moderation, central bank independence thinking is that the Bank of England and the Fed and the Bank of Japan will silently forget that they were supposed to sell off all these bonds at some point, and we'll all survive. Everything will be all right. That's one way to make fiscal policy more sustainable. But another way is to politically to have debates about whether or not the promises that were made to people in terms of Social Security programs, Medicaid programs, and so on, are tenable. People often say to me that I have this fantastic job working for an Irish university because I have a defined benefit pension, and my response is usually that the definition of the benefit I'm going to get will be whatever the government can afford. That's the sense in which it's going to be defined. So those issues exist, but they're largely about income distribution and demographic cohort type issues. In practice, it would be very easy for major European countries, the UK, US, to undertake large capital spending programs, to undertake a very significant fiscal expansion in the next time that there is a severe recession. And I expect that the political pressure will see that they will do so.
Well, thank you, Carl. All right. Now I'm going to just make some brief remarks. I actually wrote up my formal remarks in a research note that Kroll put out earlier this week. And unlike many of our speakers, my comments today do reflect the views of Kroll Bond Rating Agency, since I'm head of research. Whenever I do a macro piece, I actually circulate it to all of our senior managers so that they get a chance to comment on it and agree, because as a credit rating agency, it's important for us to have a view. And we have been writing a lot about Europe over the last couple of years. So I want to talk a little bit about negative interest rates and the Fed, and I want to end up talking about the banking situation in Europe. You know, as a child, my first Fed chairman that I got to know through my father, Richard Whalen, was Arthur Burns. And my dad had been a speechwriter for Nixon, and I was very privileged to know him and many other people through my dad, Paul Volcker, for example. And the striking thing about that period was in the 1960s and 1970s, when the U.S. was embroiled in Vietnam, and the first hints of doubt has started to creep into the aura of invincibility of the United States that had come out of World War II. You know, employment was a big deal. When I was 10 years old, we had a battalion of the 82nd Airborne Division camped across the street from my house for a month, and my mother fed them chicken cacciatore and meatballs. And it was a big deal. Washington was burning. We were under a curfew for almost a month. And what came out of that period was the Humphrey Hawkins legislation, which was an amendment to a wartime bill to provide benefits to U.S. soldiers. And it is the wellspring from which the supposed dual mandate comes from. However, if you read the legislation carefully, what you will see is that in fact there is only one mandate, which is full employment, because all of the other mandates, and there are 3 of them, are conditioned on achieving the first. So for example, the legislation had a target of 0 inflation 10 years after enactment, but only if the goal of full employment was met. So wind the clock forward 30 years, and where are we? Our central bank, in its effort to achieve full employment, has now decided that a 2% inflation target is the appropriate policy goal. That is a significant change. You know, a 2% inflation rate over 30 years will confiscate half of your value. And yet somehow or another that is acceptable because the primary mandate is full employment, at least in nominal terms. Now, you know, Paul Volcker was able to ignore that because in his era and because of his stature and personality, there were still enough people in the United States who remembered the concern about inflation that came from really the period around World War I and to some degree World War II. Inflation was a big deal. When Jimmy Carter came to Washington, a Democrat, he was horrified by the idea of inflation, even more than Jerry Ford. And I think what's changed since then is that the pressures in terms of income, the pressures in terms of opportunities, competitiveness, overcapacity, many of the things we've talked about today, have forced the central bank to more and more explicitly target full employment at the expense of price stability. And that's as it is. I mean, it's a political issue as much as anything else. Central banks are the creatures of whatever government sponsors them. Whereas our good friend Bob Eisenbeis at Cumberland Advisors has written so beautifully, the Fed is the alter ego of the Treasury. That is why they're not allowed to transact directly with one another. So, you know, if you look at where we are today with negative rates, you know, I would respectfully disagree with Carl and some of our other colleagues. Just as a short position in a security is not the same as a long position, and this is very well documented, and just as a positive number is a real number and a negative number is not, I think that negative rates have grave implications for our society because it implies a slow destruction of private entities in order to subsidize heavily indebted governments. And that is precisely what's going on. There is nothing more regressive than having the Fed buy a huge portfolio of securities of whatever sort and then give that income to the Treasury. We should be leaving that income in the private sector, in the banking sector. But instead we are putting pressure on net interest margins, as Mr. McCarthy said earlier. And the only beneficiary of this, to my way of thinking, is the U.S. government and other governments around the world, and those investors who are smart enough to play the asset game. So commercial real estate, residential real estate in the U.S., other asset classes have performed extremely well. But that's over. I mean, New York is in the midst of a reset in commercial real estate that's going to go on for years. We are buried in high-end condominiums, we're buried in retail units, and we're buried in hotel rooms. So if you want to come to New York, you can get a deal. There's no problem there. But this misallocation of resources is yet another example going back to the early 2000s when we did it primarily with residential assets. This time around it was primarily commercial real estate. And I'm not sure the average man, the average consumer, person looking for a job, the child coming out of college, has benefited. You know, my firm is one of the leading rating agencies in the commercial mortgage-backed space. We also have the best surveillance product for all commercial asset-backed securities. And we follow these things monthly. We look at the assets, we look at the tax rolls, and they're performing fine. I don't expect the prices to go down a lot, but we have too much of it, and we are going to have to, at some point, restructure it. So the thing that, as I said before, really strikes me is that if you look at a chart, I have the chart in my report, really since the 70s, when Paul Volcker drove interest rates up to 20% to fight inflation, the old battle, we've had a slow, steady decline in nominal interest rates, so that today we're basically at half a point, and we're all fretting and worrying about raising rates a whole quarter of a point. But if you look at the time series going back 40 and 50 years and beyond to when the U.S.'s needs to finance World War II were paramount, and when the Fed enabled that until the early 1950s, when Tom McCabe won back the independence of the central bank, I think that you cannot help but be struck by the fact that we have used interest rate policy to push employment progressively over this entire period. And we've kind of run out of runway. As you said, sure, we could go negative, but I think at the end of the day, unlike in the early war period when the U.S. virtually had no debt, and it was easy to lever up the balance sheet, today most nations are constrained, as was just said, and they are unwilling both politically and I think emotionally, particularly in the United States, to use fiscal policy if it means either more debt or more taxes or both. It's just a human reaction more than a rational or a technical reaction. And I think too you see that here in Europe. I always remember when the Greek crisis was just beginning and the former head of Deutsche Bank, Mr. Ackerman, went to Angela Merkel and he said, look, the banks will take half of it, you take the other half, we'll fix it. And she said no. She didn't want to engage on this. So instead, they lent them more money. So Greece today is what, $200 billion in debt? What's the total number now? It doesn't matter. It doesn't matter. And I think for a variety of reasons, perhaps because we bailed out the politicians during the crisis and afterwards, they don't have the willingness and the courage to engage on these issues, even if it costs them their political careers. If you go back to the 30s in the United States, when a guy named Jesse Jones, who was from Houston, Texas, came to Washington looking for help. Jesse was in the construction business, and he and his peers in Houston had already restructured 4 banks. They basically had dinner one night, and he said, you take this one, you take this one, you take that one, and they fixed them. So he goes to Washington and sees Herbert Hoover and says, hey, I need help, we have to go do more of this. And Hoover said, no, I'm making you chairman of the Reconstruction Finance Corporation, thank you very much, you're staying. But they didn't know what to do. They didn't have the data, they didn't know the totality of the storm that was coming at them. So that during the transition between Hoover and FDR, there was no communication, you had politics. FDR actually let the crisis get worse because he didn't want to cooperate with Hoover, who was probably the greatest technocrat ever elected to the presidency of the United States. And so by the time they started figuring out what to do with this vehicle, well, they had no leverage on the U.S. government. They could go out and fund all of its operations, purchases of gold, restructuring banks, whatever they had to do, and then they used that same vehicle to go and finance World War II. In fact, the second chairman of the FDIC, Leo Crowley, who's a fascinating figure, he and Jesse Jones restructured the U.S. economy together. If you could get FDIC insurance, you went to see Leo. If you couldn't qualify for insurance, you went to Jesse. And Jesse would look at you and go, I'm going to give you $5 million, but you've got to go home and raise 10. Otherwise, I put you in jail. It was a very simple conversation, and they got it done. But if you come back to our current period, none of the politicians today feel that urgency. And that brings me, to the situation in Europe. Last week, we saw a lot of news headlines and fretting about Deutsche Bank. Before that, we were focused on the Italians. And the thing that really strikes me is that, the EU has very conservative views, especially the Germans. They're like, can't bail out the banks, no matter what. They'll lend money to the Greeks all day long and push that can down the road. But they won't take the action necessary to get rid of bad debts and really provide an environment to help Europe grow again and create jobs. When you look at the number of €1 trillion in non-performing loans, under the international accounting rules, I can tell you that number is low. My guess is it's more like 2 or 3. The reason is it's very hard to clear bad asset situations in Europe. The courts are dysfunctional. They're very political. They don't have an independent judiciary here that deals with insolvency. It's always a political situation where the administrator is working for a government. And right off the bat, the creditors are at an advantage. We've been asked to rate distressed debt funds that buy defaulted commercial properties here in the U.S. And I talked to my friends who run these businesses, and I said, what's the timeline? What are you selling investors? And they're like, oh, 7 to 10 years if there's no, funny business. No, that's not going to get it done. So, to me, the way you get this party started, the way you help recapitalize European banks, I don't care whether it's Monte dei Paschi or Deutsche Bank, is that the governments have to get involved first. They have to come in, support the institution, stop talking about the institution in public, by the way. There's a very hard and fast rule in the United States among regulators. You never talk about a bank when it's open. That's it. And by doing that, you take the uncertainty off the table, you mark their assets to market, you really do a net value. You move some of the bad assets off the balance sheet into a separate vehicle, and then you can get private investors to come in right behind you. They want to. I remember when the FDIC took over IndyMac. IndyMac was one of the largest, more complex banks that the U.S. ever resolved. They didn't shut the bank down. They couldn't. They put it into a conservatorship instead. And when they were there, they were like, okay, we got to sell the bank. But the room was empty. Nobody wanted to get involved. And then Sheila Bair and her colleagues at the FDIC came up with the idea of risk sharing. So they threw risk sharing on the table and said, if you buy the bank, not only will we mark it down to net asset value, but we'll share the losses going forward. You take the risk, we'll take some of the risk. All of a sudden, the room was full. What investors want is certainty. They want to know what they're investing in. They want to know that the situation has been stabilized and that the politicians at least are willing to be helpful on the margins. And then I think funding this would be a relatively simple matter. But just imagine Italy with Monte dei Paschi. The Italian government's trying to convince Jamie Dimon, who was supposed to go out and raise money for them, to take it on himself because they can't get anybody to buy the bonds because nobody knows what the true situation of the bank is. What you have to do, and he can't. If he did that tomorrow, under U.S. accounting rules, he would have to market to market and take the hit immediately, so he can't do it. So I think Europe's leaders have to realize that moving with purpose, moving with a clarity of vision, and realizing that there is money out there, there's vast amounts of money that would love to get involved in Europe in a big way, in all sorts of assets, not just banks, but real property, everything else. By doing that, all of a sudden you change the growth prospects of Europe dramatically. You can start to generate jobs, and you can start to really, I think, turn the corner and prevent a political evolution that is more populist, more radical, that we already see unfolding. I'll tell you a funny story. My dad's people, I'm very happy to be in Ireland again. My dad's people immigrated from Kilkenny in 1780, and they went to Poughkeepsie, New York. And I get to talk to him. He's in assisted living now, but he's still very, very clear. And it's wonderful to still have your father when you're my age. And he said to me, Chris, progressives is what they call successful fascists. When they're not successful anymore, we call them fascists. If you take him to lunch, you get really good one-liners like this. And if you look at what's going on in the U.S. politically, if you look at what's going on here politically, in Italy, in other countries, I think it's a result of the political class being unwilling to make hard decisions that, as I say, may cost them their careers. But they have to be willing to do the right thing. We were fortunate enough in the 30s and the 1980s to have people in the U.S. who were willing to do the right thing. This time around, not so much. And I worry about that because if you're not willing to speak honestly and really tell people what you think and what you think needs to be done, then of course the public is going to be frustrated and resentful. They want people to show leadership. And as flawed as he is, as messy as Donald Trump is, that's why they gravitate to him. That's the only reason. Just the fact that he gets up and speaks his mind. He could be, a complete nutcase, but it's that aspect of truthfulness that the public wants. And if we had more responsible, more prepared people who were willing to act that way, I think we would be much better off. So I'm going to leave it there, and I'd love to open it to questions because we haven't had time for questions in the other panels. Yeah? Anybody? Wow. All right. Well, you got any questions for anybody on the panel, Carl?
There's some opinionated people out there. I bet somebody would say something. Mr. Fagan or Mr. Altig.
Yeah. Yeah. How about-
Is that not ruled out by the BORD, the Bank Resolution Directive? It's not possible now for governments to go in and do what you say.
No, you're absolutely right. I mean, the directive is a very, very draconian conservative rule. It's fascinating. And I was very encouraged to hear the remarks earlier about the, European-wide deposit insurance mechanism. But the thing is that, you don't have a fiscal mechanism, and in particular, you don't have a receivership function in Europe. Before 1933, the Fed didn't want to lend to troubled banks because if they had and the bank failed, they would end up as a creditor in a state court receivership, and they were afraid they wouldn't get paid back. That was one of the reasons the Fed was so reticent. Imagine if you were a director of the Federal Reserve Board in 1930, and you got all these troubled banks out there, and they all want help, right? But your lawyers are telling you you're not going to get paid back because this guy named Louis Brandeis in 1925 eviscerated secured lending in the United States with this very quirky decision he wrote for the U.S. Supreme Court in a bankruptcy case, Benedict v. Ratner. So, I think, slowly Europe is going to, if they go forward and they survive and they grow the union, they're going to have a unified fiscal system. And an important part of that is going to be not to just leave it to individual countries to deal with an insolvency. It's got to be collective. And that receivership has to have, as our FDIC does, absolute authority to deal with things, even to the point of repudiating contracts. One of my fun questions when I'm doing diligence on an issuer for a rating, I always ask them, I say, do you do loan participations? And they say, oh yeah, we buy participations all the time. And I say, well, do you get them to isolate the note before you buy the participation? And they look at me and they don't know what I'm talking about. And that goes back to, the Penn Square failure and other situations in the U.S. because FDIC will always repudiate contracts that they view as not being true sales because it enhances their recoveries. They love it. But yeah, thank you for the question.
Can
Go
I
ahead.
add something to that? For what it's worth, I don't think the BRD is long for this world. And we saw this come to a head in Italy, almost. They ended up with a private sector solution for MPS, but if they hadn't, there's no chance any prime minister is going to allow a haircut for depositors. It's just not going to happen. So politically, I think,
Unless there's somewhere small and important like Cyprus.
right, unless it's somewhere tiny like Cyprus, in which case they're fine with it, clearly. But I think, MPS has a private solution that's not replicable at all for any other Italian bank. So we may well see this come to a head in Italy again, in which case I think, Renzi or whatever prime minister is in this position will just go ahead and ignore the rules. And what is anyone going to do about it? The ECB is not going to cut those banks off from QE. They're not going to cut that country off from QE. So there won't really be any repercussions, and that will undermine banking union massively. So there are huge effects. But I think we could still have governments step in and just break the rules.
Well, the thing is, this has been going on for a while. The institutional investment community figured out what was going on in Italy 6, 7, 8 years ago. They backed away, and then all these banks had to go out and fund themselves with retail investors. And the product says deposit, okay? That's not nice. But that's what they did because they didn't want to deal with it. So now you have retail-funded banks with solvency issues. And I think Megan's absolutely right. It's never going to happen. It would cause a political crisis in the EU, but I don't see them haircutting. Because the implications are amazing. And again, imagine Merkel, whether she did it or not, coming out and saying they're not going to support Deutsche Bank. When Citi came and bought their third-party credit default swap portfolio, I went to church and, I was like, thank you. Because, you don't want a big book like that in we can't. So now, by the way, Citi, having taken out Credit Suisse and Deutsche Bank, is the largest derivative shop in the United States again. Interesting little factoid. Anybody else? Sir?
So I have a comment and maybe what's a question, I'm not sure. So my comment is the 2% inflation targets actually did not come out of thin air, and they didn't come from a place where, I mean, I disagree with the comment that it was the subjugation of price stability mandates for employment mandates. So Bernanke wrote, gave a speech, I guess, when he was a regular old governor, on the optimal long-run inflation rate. Whether you buy it or not, I mean, you try to make kind of a finely tuned sort of argument for we have a dual mandate. That means you have certain trade-offs that you need to kind of respect. And so 2% was like a number that wasn't too high, and there was some evidence that kind of supported that. Came out of largely the IMF, I think, kind of showed these threshold effects. But it gave you some cushion, which is now drawn into question with the kind of R-star sort of arguments, to deal with kind of not hitting the zero bound when you needed during a period of time to cut rates fairly significantly. So I don't, we can ask whether that needs to be recalibrated, but I think it came from a place that kind of respected the mandate of at least the Fed and probably the ECB as well at the time. My question is, and I don't really exactly know how to pose it, but we all have conversations like this all the time, and kind of to summarize this panel, every panel that we can think of, we're in a terrible mess. And the solution always sort of seems to sound like, boy, if we just had smarter and better people in charge, we would get out of this mess, which surely must be wrong. I mean, we're missing something, and nothing. There's nothing that kind of indicates that we're missing something more than the American political process right now, where people are where everyone is telling us we're missing something. So what is it we're missing?
Well, so my argument is that we're missing business cycles and robust growth, and that's all because of the lack of aggregate demand. And one surefire way to generate aggregate demand is to implement wealth redistribution policies. If you can show me a politician who's willing to do that, I'll eat my hat. It's just not going to happen. It's so politically toxic generally. So there are other ways. Infrastructure spending could help certainly, and we should get that in the U.S. regardless of who wins the election. But
So I know the narrative is different, but if you go back to the Bush years, and I mean before the sort of stuff, his first fiscal policy, major fiscal policy effort, massive, and not to the high end of the income distribution, massive middle class tax cuts. So took people off the rolls, by large. There's been large redistribution that hasn't done the trick. I don't know if people believe that there's that sort of redistribution.
I think it's.
Maybe it's not the right kind of redistribution.
I think it goes back to the question we had earlier on your panel, which is that, the U.S. rebuilt the world. We spent a lot of money. We borrowed a lot of money. We forgave a lot of debt. And then all of our trading partners eventually got to the point where they could really compete with us. And they did. The Chinese funded the housing boom in the 2000s by recycling all those dollars. And that's been largely on the back of your blue collar and middle class Americans. It's easy for the wealthy to maneuver in this environment. They have the ability to do so. But I've got my book on Ford coming out at the end of the year, and just watching the progression of the U.S. automakers is they had to deal with one new competitor after another washing up on shore, not being very good when they started, but by the time you get to the late 80s, early 90s, the three automakers were fighting for the bottom third of the market, and the Japanese and the Germans owned everything else. And you know, even today, as much as Ford has recovered, they're still not competing for the top third of that market. They're trying to, but it's extremely difficult. So you imagine that in the context of that auto worker, and he's now in South Carolina. He doesn't have the bennies he used to have, all that health care, everything else that Walter Reuther won during the 50s and the 60s to keep labor peace, right? They could never afford it. If you went back and looked at all those bennies, those companies could never afford it. In fact, I think GM will go through the ringer again, just because of their pension and health care liabilities. And it's global competition. Just to summarize it, you know, we have to compete. So you know, you don't argue with the classical argument about free trade, but there is a cost. And I think the only thing that saves the United States is that we're still a developing country. You know, we have this periphery where you have, you know, capital inflows and everything else, and then you go to the middle, asset prices haven't moved. They haven't built condos in Chicago in 10 years. There's no demand. There's starting to be a little demand now, thanks to the Fed. But, you know, seriously, you know, it's all on the periphery. That's where the biggest movement in commercial and multifamily has been.
A quick comment about the 2%. I was slightly joking about there being nothing missing the paper. During my time at the Federal Reserve, one of the discussion papers I remember about this question of the inflation target and so on pointed to the fact that that official inflation indices probably underestimated or overestimated inflation, and that could be as high as 2%, right? So 2% could actually really be price stability, and it's probably fair to say that over the last decade that the challenges facing statistics offices and measuring internet-related products and measuring lots of products is extremely difficult. So I suspect that bias is probably increasing over time. Right? So you know, I pay $9.99 a month for Spotify. I have done so for 5 years or something. It's much better now than it was 5 years ago. But so basically, that's a price cut. I pay more. I'm getting more consumer surplus, but it's not showing up. So I think that partly means that things actually are probably not as bad as they look in terms of GDP growth statistics, that more of the growth is coming in areas that are just very difficult for the statistics to collect. A final thought, I don't know about this idea that the smart people can get in a room and should be able to sort it out, and we don't have enough smart people. It's sort of endemic everywhere, but it's particularly bad in Europe. So in Europe, people have convinced for years, so it goes back to this famous Juncker quote about we all know what to do, but we won't get re-elected if we do it. Personally, I think that's a load of nonsense. So the things that they think they all know how to do are pension reforms, product market reforms, labor market reforms. The truth is, go and take a look at that stuff and figure out what do you think it would get you, and benchmark it against stuff elsewhere, and how long you think it would take. And at best it would add 2, 3, 4 tenths of growth for a while, and then peter out. The truth is there's an underlying pattern in Europe of poor productivity growth, of poor demographics, and there's no genius that knows how to solve it all with a few well-tinkered pension reforms or whatever. The demographic one, there is a solution, and it's to let lots of immigrants in. But we all know the difficulties there.
Well, let's give our panel a big hand, not me. Thank you, guys.